Hi, my name is Roger Schluter. This video is actually about other alternative financing sources. And really it's like the third of a 5-part video set on financing your business. The 5 parts are bank financing, personal ways, other financing, which this is, crowdfunding, and peer-to-peer financing, and then other equity and incubator financing. So anyway, this is other alternative financing. This is the third part. Anyway, and it really goes over how to finance your business with other alternative financing sources. And alternative financing is getting your financing from a source other than banks and credit unions. This video will show 7 alternative financing sources that will allow your business to grow even if your loan is not bank eligible. So the first of the other alternative financing sources, first one would be factoring invoices. Now this is really for an existing business. This is a form of accounts receivable financing. The company's unpaid invoices are leveraged to come up with quick cash until the invoice is paid. And usually this is done by a bank. Sometimes the bank will have a lockbox that will have these payments go in and will come to, and that lockbox will be at the bank. So anyway, but it is a way to take your accounts receivable and get your cash today rather than waiting for whenever that company is going to pay you. 2 parts to this. Invoice factoring is where the company will give you a percentage of the value of the invoices in cash. The amount is based on how creditworthy the company is, that owes you money. Meaning that, I know Walmart sometimes doesn't pay that quickly, but if it's a Walmart invoice, I think you'll probably garner like 90% up front, of the value of the invoice. I would be the same if you're talking, a company it used to be Monsanto, or a company like General Motors, you get the bigger companies, or even in St. Louis, like used to be Anheuser-Busch, InBev, something like that would be, where you'd get 90% of it up front. And then, the remaining 10% would be paid when the total invoice is paid. The lender would collect for the invoice. And like I said, one way of doing that is having basically a lockbox where those companies that owe you money send their payments to. And that way the bank can control those payments and doesn't have to worry about you, paying the bank. They just would be afraid you might do something else with the money. The other, which isn't as, which is a little more costly, is invoice financing or discounting. The lender pays you up front or grants you a line of credit of the percentage of unpaid invoices that you collect and pay, the bank in interest rate and fees, after you collect the invoices. So anyway, it'd be more like a line of credit, the unpaid invoices. And like I said, invoices can be, they can be in 30 days, but I've seen a lot of them go, 90 days. And usually the bank will give you credit for stuff up to 90 days. But a lot of times when it's past that, they do not, either 90 or 120. So, you can get these older ones, and it's just a way to get upfront money, for that. Leasing of equipment. This is one that's been around forever. And this is for basically equipment. You could probably do furniture fixtures. You could do some items, but this isn't really for like a building or something. And it is basically, where it's a very tried and true method of financing, been around for a long time. The leasing company actually owns the equipment, and then the borrower pays a fee, a monthly fee, to the leasing company, after which the leasing company, after it's paid off, it basically sells the borrower the equipment for a small fee. The costs are higher, but the eligibility is very easy, for the borrowing company. In doing leasing. The other thing is, a lot of times leasing is kind of called off balance sheet because it's not a loan. So being it's a lease, you don't own the equipment. So the leasing company owns the equipment, and you're just paying for the use of it. So it's more like an expense, and I think it's treated like that with most financial statements. So anyway, for that aspect, it really doesn't show up as a liability on your balance sheet. And it can or cannot. It really kind of depends on what the laws are right now. I know it used to be used as a so it wouldn't show up. So anyway, the next one would be business credit cards. And I know I talked about this in a prior one, but business credit cards are issued by banks and can be, provide purchasing and working capital to a borrowing company. The interest rate would be higher than regular financing, but most business credit cards are fairly easy to obtain. So anyway, that is another method. The number 4 would be microfinancing. And if you have a very, very, very small business that needs a relatively small amounts of capital, and this is usually amounts up to 50,000, so 50,000 and less. I think sometimes they can go up to 100,000. But anyway, SBA finances several entities in the U.S. that do microfinancing up to $50,000, and most banks, will only finance a company with an amount of like over 100,000. Banks really don't like financing business loans, until at least 100,000. And many banks that I've had people look at, a lot of times will just tell a borrower, if he's trying to get 50,000 or less, they'll just say, hey, just put it on a credit card. But most small businesses or people I know don't have credit cards with $50,000 limits, or $50,000 of availability. That's quite a bit. So anyway, check your local SBA office for a micro loan provider in your area. The number 5th one would be, and this would kind of be for, there might be ways you could do it for a new business, but it might be for existing businesses. What would be great is if you could basically sell your product today for use in the future. This can be done most easily by selling gift certificates. A lot of these are done by restaurants and that. So the business sells a gift card to the business. It is actually supposed to defer the income on the books until the gift card buyer actually, buys the product with the gift card. But the money's there to use. Word on the street is that 20% of all gift cards are not redeemed. So let's say you sell $10,000 in gift cards, then it maybe only cost you like $8,000 if 2,000, if 20% aren't redeemed, and then that $8,000 will cover, let's say it's a restaurant, will cover food costs that are usually about 25 to 30% of the total cost, because the other would be other things in the restaurant. So anyway, which could be as little as $2,500. And you keep the rest of the money. So these can be a real money maker. Gift cards can. So anyway, if your business could use those. The number 6 thing is grants. Now I used to say all the time, if you find somebody who will give you a for-profit business a grant, tell me, because I don't know of any. And they have, since the pandemic, or since that in 2020, they have become a lot more, they're around a lot more, because a lot of states and cities were giving businesses grants, kind of to weather the storm, so to speak. Grants are mostly seen on the not-for-profit type of organization, but SBA and some other for-profit organizations are giving some grants. But you would have to contact them, those organizations, to see if they're currently making grants available, for a for-profit business. Some are geared to certain things, like I think SBA has one which used to be called the SBIR program, and I think it still is, but I think it's called something else too. But what they do is they do grants, but they do them for high-tech stuff, for people for people who are trying to satisfy a government need. So the government would come out, like let's say, the Defense Department would come out with the grants for a certain purpose, and then you could apply for that. But what you're trying to do is get things that are useful by the Department of Defense. So this is a very narrow thing, and it's usually just for high-tech stuff. Merchant cash advance. The merchant cash advance provider gives the business a lump sum of money and then receives a percentage of the company's debit and credit card sales to cover the loan. Now, the provider will charge an interest rate and fees to cover their services, but they usually charge a factor rate, which would be a factor of the amount of the loan, meaning that if the amount of the loan is $100,000 and the factor rate is 1.25, then the payback would be $125,000. The $25,000 would be the fee. And this is if the amount of the loan is $100,000, could be less than that. This is usually less. This is less than a year. So if you want to equate it to an annual interest rate, it might be like 25%. But the things that they're financing are going to be a lot quicker. They're basically talking about, giving you, receive percentage of companies' debit and credit card sales. Well, your debit and credit card sales are paid back pretty quick. Of course, this should be an ongoing amount that's there, but still, it's very expensive financing when you really lay it all out. So anyway, you do have to remember that on debit and credit sales, which are very short-term payment, repayment. So I don't think that is for anybody, and a lot of people say that's kind of a last ditch type loan for a business. Summary: most of these financing methods are alternative financing, meaning sources other than your usual bank loan. They can be faster approvals with simplified paperwork. Many will not look to the credit of the owners to qualify for the money. A lot of times they'll just look for the company. So anyway, please subscribe to the channel if you like the content, and please hit the bell to notify you of future videos. If you received any value, I would hope you'd hit the like button. This does help the video to be sent to more people on YouTube. So anyway, my name is Roger Schlueter, and I will see you in the next video. Thank you very much.